When making real estate decisions, one of the most frequently asked questions is whether it's better to invest for cash flow or appreciation. Now let's talk about these two investing strategies. As a real estate investor, you should understand that both strategies are valid and can be combined when you're looking at a deal. So it's important for you to know how to determine the real cash flow and also the upside when it comes to appreciation rate. This is going to vary largely on the asset type, but in our case, we're going to talk about multifamily. A cash flow strategy offers consistent cash, typically in the form of rental income to real estate investors. Now, over time, the property may also benefit from appreciation. With equity accumulation, an investor could refinance, sell, and use those returns from investing for cash flow and appreciation to invest into a new property. Now, if we're talking about commercial properties like multifamily, you can find many ways to improve overall cash flow depending on the market. For instance, you can offer trash valet, pet rent, and other amenities that provide value to the people living there. And it's going to bring up overall income. And when you bring up overall income, you also improve overall value. That's how you bring up the appreciation on one of those types of deals. Now, in an appreciation strategy, it offers a long-term approach to building wealth. Rents typically grow over time, leading to increased cash flow. But you're going to see negative cash flow usually on these types of properties, and it could turn positive over time and also allow you to make some significant profits through appreciation. Essentially, the way you make money in an appreciating market is when the property is sold. Hence, it's a long-term gain. In both cases, there's typically certain markets that lean either way. For instance, in the Midwest, typically there's a lot of cash flowing markets, meaning you'll see some consistent cash flow coming in from an asset and you'll see some appreciation. The good thing about these markets is that they rarely experience large fluctuations that you see in these appreciating markets. Now, in appreciating markets, like think of New York City, Los Angeles, Chicago, you're going to see lower cap rates. You're going to see a great deal of movement in and out of those areas. And sometimes you're going to see where the rents, the NOI, is just enough to cover the debt service, the expenses, and provide some level of return. The reason why people get into these types of deals is because they expect the asset to sell for a far greater price down the road. These are the types of markets that have historically been very, very popular and very, very dense. Demand is always going to be strong for these types of markets. People are always going to live in New York. People are always going to want to live in Los Angeles, for instance. So they're hedging their bets on that. Now, as I mentioned before, you can combine real estate appreciation with a rental cash flow market or strategy for these types of properties. For example, we're currently doing a development deal here in Cleveland. In these types of deals, our investors are jumping in today and they're going to experience a good, hefty return in about 12 to 24 months, depending on the deal size. Now, there's neither a winner or a loser when it comes to these types of deals. They're not exclusive to one another. Both appreciating and cash flow deals complement each other. Now, in our case, we're investing in cash flow markets and these cash flow deals because of current economic circumstances. That's why we decided to just hedge our bets there. And our desire is to generate cash flow for our investors. So we are staying in those types of markets. Anyway, let me know what you think about cash flow versus appreciation. All right, leave a comment and let's talk. Talk to you soon.